and we're going to go right to the class. Okay. So we're in just give me 1 second. We're in vertical, horizontal, and ratio analysis. So this week, you got to describe the purpose of horizontal, vertical, and ratio. Horizontal basically means you're picking one point in time. I'm getting like real sun right in my eyes. You're getting one point in time, right? And you have to analyze a company one point in time, against other companies usually. Horizontal is like time series. Let me share my screen. Let me make sure I'm sharing my screen. Let's close that for a minute. So make sure I'm sharing my screen. So, Angelia, just tell me, you should see my, you should see the screen for Rasmussen. Do you see it? Excuse me. Do you see the screen? There's one thing about Teams, it doesn't show you what you're showing. If you could just let me know that you saw the screen, it'd be great. Go to, okay. And we're being recorded, obviously. All right, so hopefully you can see this. Yeah, okay, tremendous. If you can't see the screen, like, if I'll tell you what I'm showing, I just don't want to keep recording and then people who watch it can't see it. So right now I'm showing the Rasmussen screen, right? And you're going to do a quiz, the video lecture, and you're going to do all your Connect assignments. But let's talk a little bit about vertical analysis, okay? So when you're analyzing a financial statement, a reader will either look for a company's liquidity. Liquidity ratios would be like current ratios, cash ratios, how much cash you have in the book, how much liquid cash you have. Really important to understand that, because if you don't, you can actually cost yourself a lot of money by not understanding it, right? Why is that? Because, you can put yourself out of business. Like, for instance, Bed Bath & Beyond was not a terrible company. It was actually, people did go. Now, of course, it was affected by Amazon and all this other stuff, but people did go to Bed Bath & Beyond. The problem with Bed Bath & Beyond, the problem they were having, is they started to run out of cash. And once you run out of cash, think about what happens. Companies don't want to do business with you. They're afraid they're not going to get paid. They won't deliver the items you need to sell, and that's just going to put you right out of business. So liquidity is an important ratio to kind of keep an eye on. And, of course, profitability. And profitability is how much are you generating from your assets? How much are you generating? What's your return on assets? What is, your assets are the things you use to make money. It could be buildings, it could be trucks, it could be people. But, remember, and if you studied economics, there are the four basic resources that build an economy: land, labor, capital, and entrepreneurial ability. So those things are basically, land is like, anything you rent, you're going to need land to do something. Labor, obviously, you need people, right? You need people. And land, labor, capital is going to be the things you buy, right? So, of course, this is really important because that's how you're going to generate income, right? So profitability is a function of how much money you are actually earning against those resources. Because if there are more profitable ways in economics to use those resources, then that's where the resources are going to go. Another company will pay higher prices for those resources and make it impossible for you to use them because there's a limit to how many resources we have. For instance, there's a limit to how many people we can hire. There's only so many people who work, even in the United States. So as some businesses become more profitable, they are the ones who are going to attract those employees because they can pay them more, frankly. All right. And then solvency, how much debt do you have on the books? Can you afford to pay the debt that you have on the books? So these are all really important, right? So every item reported in a financial statement has significance. To make a proper analysis, we need something to compare the numbers against. And what we'll do is we'll look at prior years. So on an intercompany basis, we'll look at these numbers within the company, such as comparing this year's financials to prior years. Then we compare it to the industry, right? So you look within your company and you compare it to prior years. Then you compare it to the industry, and then you compare it to most of your competition. And generally speaking, we want to look at what's going on in our company. We want to look at what's going on in the overall industry, depending on how you define that industry. Like, you could talk about retail, and that really is a wide area of definition because there's a lot of companies that that are in certain industries, right? There are a lot of companies that are in certain industries. So you might want to compare against industries. And then ultimately, you want to look at other companies that you compete against. So commonly used tools are horizontal analysis, where we evaluate a series of financial statements over a period of time, okay, over 1 year to the next, one season to the next, and everything else. So we say horizontal because think about horizontal. Horizontal means that we look at different years and we compare to the years. It's horizontal, it's across. And this gives us an idea as to where the changes are coming. So if you look at this company, obviously their debt has gone down because they reduced their debt from year 3 to year 4. So that helped their income. And but they increased their administrative expense. So to the untrained eye, my feeling would be, right, to the untrained eye, my feeling would be that this is a little risky because they've increased their overhead, but their earnings have gone up, but their overheads have gone up a lot more. And the only way they were able to kind of get the same kind of year, maybe did a little better, was they took some of the debt off. And sometimes having debt is not a bad thing. Debt allows us to grow. We don't want to have too much debt. So that's how I would read this. That's how I would definitely read this, okay? So I know I only have Angelia here, but if you had any questions, you can mail them to me. But that's how you do in horizontal analysis. Now, vertical is a little different. Vertical analysis is you're evaluating the financial statements, right? You're evaluating the financial statements. Just give me a minute. I want to answer a student. Okay. You're evaluating the financial statements that represent each item in the financial terms of percentage of a base figure in the income statement. So you're looking at a base figure, usually sales, almost always sales, and you're going to compare all the different parts of your company as a function of sales. So you could see here that cost of goods sold did go down as a function of sales. That's a meaningful number on a percentage basis. You might not notice that just by looking at the numbers, unless you really are like incredibly astute, just looking at different math. But now you can see where cost of goods sold went down. That'd be a question you want to ask. How did you get your cost of goods sold better? And that's how you increase your margin. Now your operating expenses did go down and did go up, I'm sorry, and that's not a good thing. And we just talked about that. Administrative expenses went up. And that's kind of tells you the story of this company. So that's where we would focus, right? That's where we would focus. And that's how you do a vertical and horizontal analysis. Now, I want to show you something. Give me a minute. Okay, I'm back. I'm sorry. I just lost you guys for a minute. All right, so now let's go to the next thing, and we're still recording. To make sure we're still recording. Okay, good. Now I want to show you something. And again, Angela, you got to help me out here for a minute. I want to show you a video that I prepared on ratio analysis, and it's been very popular. And I will put this video in the week's work. Okay. So just bear with me for a second. All right. Bear with me. All right, here we go. And it's in my Finance Academy. But you go right to my Finance Academy, which I offered you in the beginning. But that's where you could see everything on this. Just give me 1 second. Okay, it's an overview of ratio analysis. Okay, hold on 1 second. Now I'm going to go back here. And I want to share. So bear with me. Oh, here we go. Great. Add share live OBO. I do. Okay, good. Let's watch this together. There's a ton of websites that talk about financial ratios. Obviously, this is one that I'm using, but you could look at just about anything. And in of course, our textbook is most important. But just to go over how to look at financial ratios, I want you to understand that you have to look at ratios in an absolute sense, not in an absolute sense, in a relative sense. And I spoke there for a minute. So, like a doctor would look at a blood test. There are obviously some numbers the doctor doesn't want to see, but on the other hand, there's no question that they have to take into account the whole patient. I mean, the history, where the patient's at, what they're dealing with. You know, a white blood cell count may not matter if they're in the middle of a flu. It might matter if there shouldn't be an issue. And why am I saying that? It's because when you're looking at financial ratios, you want to take in a more holistic approach. So, for instance, you know, you have your profitability ratios, and you have your current ratios, and obviously I want to stay current, and it always seems like it's a good idea to have more current assets, and it is. But then again, you have to look at it in the context of the business you're in and what your competitors are doing. It's not just an absolute number. None of these numbers are absolute. So, for instance, on receivables, it might always look like a good idea to collect your receivables quicker, but if you're pushing your clients too hard to pay their bills, they may decide to, you know, decamp and go to another competitor that offers better terms. So while it's a good idea, you want to also be able to sit down with each of your clients and decide if it's the best idea to have push them for another 10 days or 15 days to make those numbers look better. Another one would be inventory turnover. Obviously, it looks like a great idea if I turn over inventory quicker. That would be a good idea, no question. We don't want to carry a lot of inventory. It could be dead weight on the shelves or for an auto dealer in the parking lot. But on the other hand, if I'm not carrying enough inventory, my clients might not like that idea. They may want to see choices. You walk into a store, you want to see choices. Otherwise, what was the benefit of getting in a car and going to the mall or going and looking at a car deal? So you have to be careful when you look at these numbers, not to use them absolutely, but to use them relatively and to make them the starting point of the questions that you ask. Another one is accounts payable, you know, accounts receivable, accounts payable. You know, of course, we'd like to delay our payables as much as possible, but on the other hand, we don't want our suppliers to start wondering if we can make our payments. That may look bad with your reputation in the industry. So all of these things have to be taken into effect when and into thought when you're looking at different issues. So another one that I like to point out is the asset turnover number here, number 9, when net sales over average total assets. Again, a number you would want to see two companies. One company has a high asset turnover, another one, company B, has a low asset turnover. Obviously, we would want to take a look at company A because we think that's a better idea, but we might find out that company B had just put in new factories, new production facilities, in which case that would make their net sales over average total asset would lessen it, right? You have a higher denominator. But it also means that company B has new stuff, that they could be more effective, they could be more efficient, that in the future they're prepared for, you know, take for instance a production facility that's been revamped. It's going to be a more efficient facility that'll be around a lot longer, where company A has old equipment and they're going to be paying that price at one point. They haven't upgraded, you know. So again, asset turnover is a number where it just starts to question. Doesn't kind of, you know, obviously, if you look at it over the course of the whole industry, you get a better idea of where it should be. And in the end, what ultimately matters, debt ratios are important, times interest is important, but earnings per share, you know, that's where you really know what the market values at. And I like that. And price earnings ratio is the most important, I feel, because it's what the market thinks. It's where the market is betting their money. And if the average price earnings ratio right now is around 25, which implies about 1 divided by 25 is a 4% return on the market is, you know, requiring your stock to return 4%. Well, if it's higher than that, then the market obviously feels your earnings are going to grow and that you're in a better competitive position. And if it's lower than that, then they think that you're a mature company. And you may want to look into why they feel that way. So if you're gauging a company, price earnings ratio is really important. So that's just a preview of where I want to head with this. I will be doing more videos and taking apart each one of these ratios, but that's a start, okay? So thanks for listening, and stay in touch because we'll be doing more of this.
Today we're going to look at equity valuation. I prepared a...
Okay, while we're on this subject, I want to show one other video that well, first of all, I want to take that last video and hopefully you found this helpful. And if you want to watch it again, right, if you want to watch this video again, I'm going to put it right in. Okay. Hold on one second. I'll put this video right in on messages. Hold on one second. Okay, so it's in your messages, so you can find it right there. All right, now give me 1 second. I'm going to show you one more on financial, hold on 1 second. And I want to make a video at one point. I'd like to make a video on using MSN Money because I think that's really another very good system that I think you'll find interesting. But bear with me 1 second. This is a short video. Give me 1 second. I know in the beginning I gave you my accounting channel. My worry sometimes is, people, not that you're not watching it, you got plenty of work that we give you, but I want to make sure that you get the most out of this. I really do. So give me 1 second. Give me 1 second. Okay. All right. Because there's not a lot of guidance here, and I want to give you as much guidance as possible. So let's watch the. Now, this is an introductory video that I have in my Accounting Academy. And you can go back to the information on my Accounting Academy to get as much information as you need it. But take a look at it, and then you can watch the other ones, and I can send you my interactive spreadsheet. So this is a good way for you to refresh yourself on how we find the information to put these ratios together. This is the first in a series of kind of a review of the basic accounting theory. This kind of works with finance classes. It also is very helpful if you're an accounting major. Either way, it's really helpful. As I have degrees in accounting, economics, and finance, I try to bring it all together, and I teach statistics. I try to get it all together and present it in one format. So I've created this fictional company, Tom's River Corp, and there'll be 3 or 4 parts to this series, because I want to start with the income statement. Then we'll do the balance sheet, retained earnings, statement of cash flows, and an overview. But if we look at, let's focus, and this is an interactive spreadsheet, and that's why I created it, because by using it, you get an idea of how how these statements should actually flow. So we see that on the income statement, and every company has an income statement, whether it's a small mom and pop business or it's the Coca-Cola Corporation or the International Business Machines Corporation. Either way, you are going to see an income statement. We'll get into the balance sheet in the next video. But here we have sales of, well, it's all in thousands, and you always want to watch out for that too when you're studying. So this is in thousands. So the sales for this company would be approximately $3,074,000. And if we take out the cost of goods sold, and watch up here, because that's, for those of you who have a good knowledge of Excel, you'll appreciate this. And if you don't, it's a chance for you to start to begin learning Excel. The cost of goods sold in this issue is $2,088,000. So when you subtract what it costs of raw materials to create these sales, and this is obviously something like a manufacturing company, service companies, finance companies are going to look a little different. And obviously that's why you have to keep studying to learn the different nuances. But at the end of the day, it all looks the same. So gross profits are $986,000, and notice up here, I subtracted sales from cost of goods sold. Now we take out our operating expenses. So selling expenses would basically be commissions, what you pay salespeople. Maybe you outsourced your sales. However that worked, the accountant would plug this into selling expense. Administrative expenses would obviously be legal, accounting, overall administration of the firm. And the reason why we break these out is we want to see what our profit margin is versus what our raw material cost is. And not just, and we're going to learn this in further videos, when we look at ratio analysis, we don't just compare our cost of goods sold on an absolute basis. We look at it relative to other companies within the industry. So for instance, in some industries, cost of goods sold might naturally be very high, and the company makes money on financing or different things. Here, in this particular industry, and we just made up this industry, we hope that this ratio of 986 to 3074 is commensurate with the other companies within the industry and makes sense for that industry. And if it changes or varies by much, we're going to want to ask that question. So these numbers kind of are included where you start asking questions. Another expense might be the leases that we have on automobiles, on different copiers, things like that. And then a very important number is depreciation, which I'm going to spend some time in a different video on depreciation, because it's such an important part of the of understanding finance. But basically and quickly, the government urges us to start businesses and create businesses, because when we create businesses, we create work, we increase the GDP, and we have more people who are out in the workforce paying taxes. Then that's going to be another video. But what happens is when you build a building, when you do anything of a capital expenditure, a building, a truck, anything you buy, the government allows you to write it down against your earnings. So it becomes a non-cash expense because you've already spent the money, but you're able to deduct it from your earnings so you pay less taxes. So again, this is a video for another time, but to some, it's like your mortgage. You don't actually pay the entire mortgage. You're paying the mortgage less the amount you deduct from your taxes. So depreciation is a way for the government to encourage us to invest in different things. So we get to deduct it from our taxes, and that becomes part of our expenses. And notice that our operating profits are now going to be the gross profits minus the operating expenses. So we have operating profits of 418, which was reduced by the depreciation. So then we take out our interest expense, and then we have our profit before taxes. And again, if you look up here, you'll see that helpful formula for how I did the Excel. So now the taxes actually come out of, the taxes, in this case, I just plugged in a number because I didn't use a percentage, but they're a percentage of our net profit pre-tax. And if you do 924 divided by 325, you're going to get that number. But notice that tax number, the pre-tax number, the number we generate, the number that generates our tax liability is inclusive of this depreciation number. So you see how if we didn't have depreciation, this number would be higher and we would pay more taxes. So the government is effectively picking up, if you do the math, and again, I can't say this enough, we'll do this in another video, the government is effectively picking up our tax rate because they're reducing our taxes. So afterwards, and we're the government, net profit post-tax will come out of these two numbers. And then any dividends we have to pay, preferred dividends, which is another subject. What a preferred stock is, it's basically debt. You know, it's not really equity. It comes on the equity side of the sheet, and it helps banks and firms that need to show more equity. But at the end of the day, it's debt. It's like a debt. It's like a perpetual debt, but it is preferred. So we have to pay that dividend, and then that's the earnings that are available for our shareholders. In this case, we have 76,262,000 shares outstanding. And when you divide your earnings by your shares outstanding, you get that all-important EPS number. Again, another important metric. EPS is the way we could look at how much our shares are earning. For instance, if this stock was a $29 stock, our EPS would be earning 10% of the our earnings would be, our stock would be generating 10% of its value in earnings. And that would be our return on equity, so to speak. But there's more to that, and that's got to be another. This is more of an accounting treatise, but there's going to be more that I'm going to do in terms of EPS. That's important for me to explain to you. I'm going to put this under the Finance Academy, and I'm going to create an Accounting Academy, so you have both for my students, okay? I'm just writing it down, so remember to do that. And then finally, we have the dividends we pay, which is, you know, the board of directors and the chairman decide how much they want to pay. And it's a function of what they think they're, you know, again, the clientele effect, what kind of what our shareholders are expecting, what's reasonable for our industry, what's reasonable for the market, and that's our dividends per share. So if you look at this balance sheet again, and if you send me an email, and if you in the comments, if you're one of my students and you send me an email, and in terms of requesting in the comments, I will send you a copy of this spreadsheet. I have no problem doing that. I would like to do it, but I need to know who needs it. And anybody who really wants to see it, just give me a place where I could send you give me your email, and I will send you these in the comment box, and I will send you this interactive financial statement Excel spreadsheet. But that's basically it. Go through this again, watch my video, and we will do the rest of these, which is the balance sheet, and then the retained earnings, and then the short-term cash flow. We'll also be talking about earnings per share and price earnings ratios, and then eventually we'll be doing videos on financial ratios. All right, so again, this you could find. I already gave you my accounting spreadsheet. It's already been in everything that I've been showing. Hi, Abigail. Nice to have you aboard today. And you could just get that right out of there. You can get that right out of there. You could just go back and watch those videos. And if you and my accounting spreadsheet is there also, so it's all there for you. Just to get back to this week's work, go back to content. That's how you're going to do this type of analysis. So, getting back here, I got 2 classes, so I go back and forth. You know, what are some of the, so to go back to ratio analysis? It really is going to be exactly what I showed you. So you're going to have things like the liquidity ratio, as I mentioned. It's your current ratio. It's how much cash you have on the books. It's your current assets divided by your current liability. Basically, how much short-term cash you have and short-term receivables that you can turn into cash, hopefully, and you'll collect them. Usually, if you're in business for a while, the receivables will become income over the money you owe short-term, your accounts payable. So that's where that's going to come from, right? And sometimes we worry about these receivables, so we take out inventory. By taking out inventory, we adjust the short-term cash to reflect the fact that all receivables might not turn into cash. So if you're holding like gold as a jeweler or cars as an auto dealer, that's pretty much something you could turn into cash. But if you're doing stuff like clothing or certainly perishable items, I would take those inventories out. And that would give you your coverage. And how often do you turn over these receivables? In other words, given the fact that you lent money out, how quickly do you get that into cash? That's part of your liquidity. The faster you can convert receivables into cash, a cash conversion, the faster you're going to get that money. Think about it. You loan somebody money to buy your goods, and what we're looking to see is how long does it take you to get that money paid for? You've given them the goods. So obviously, if you have good clients and they pay continuously on the same terms, well, you know that cash is coming in. And the more mature your company, the more we're going to be able to do using a horizontal analysis. Horizontal. We're going to be able to look at your receivable turnover and make sure that it stays consistent. And sometimes people say, well, why not even collect it quicker? Well, if you got good clients and they're always used to paying within 30 days, and they've arranged their business that way, and they've been with you for a long time, you don't want to push them too hard. You start telling them 20 or 15 days, they may turn around and say, you know what, I'm going somewhere else. On the other hand, you leave it alone. If they keep working, if nothing gets aged, which means it takes longer than 30 days when it always took 30 days, then you leave it alone. But that is receivables turnover. Then finally, inventory turnover is, if I'm taking on inventory, how quickly do I hold on to that inventory before I have to replenish it? Now, if you look at a company like Costco, the real secret isn't that they sell goods. The real secret is that they only hold one of every product. So people are also almost trained to buy that one product. Now, in some cases, it's easy. You need cotton swabs, it's Q-tips, right? You need pain reliever, it's Tylenol. I mean, that is the product, basically. I mean, Aleve and Tylenol. But there are some things like tomato sauce or tuna or things like that where they give you a specific brand and people get used to buying that brand. The beauty of that is that people feel they get a good deal with Costco. They stock up. But what happens with Costco is they don't pay for these goods sometimes because they're so big they can arrange their terms better. They may not pay for these goods for 60 days, but they're getting their cash or they're turning over their inventory every 12 days. So if you do the math and you think of the enormity of Costco and you're turning over inventory every 12 days, but you're not paying for it in 60 days, it's a good business for them. So these are liquidity ratios, right? These are liquidity ratios. In terms of profitability ratios, you got your profit margin, which is how much you're making on your net income, how much your sales is generating net income. And that's going to be different for the different industries. For instance, Boeing Boeing that makes huge aircrafts, they're going to get a higher profitability ratio, but they're not selling as much. I mean, you're not buying that stuff every day. These are long-term contracts, so their profit margins are higher. But on the other hand, their turnover is not quick. But someone like the local supermarket, they can have very small margins, but they're turning stuff over quickly. And that's generally the way it works. The more turnover, the less profit margin. I mean, you would love to have a business where you have a high margin and quick turnover, like Apple. Right? That's good. That's really good. But even Apple has to be careful. They start overcharging for phones and people find competitors. But that's what makes a business going from good to great. That's why Apple is a great business, because they have a pretty good profit margin and they turn over quickly. So and they get their cash right away. So they have more cash to invest. So net cash over net sales is a real important number, because we want to make sure that we're getting that we're turning our money into cash. We're turning our sales, I'm sorry, into cash. Then when we look at asset turnover, that's another important number. How quickly am I turning over my assets, or how quickly are my sales over my assets? So you got to be careful here, because I can look at two companies in the same industry, and one company might have a better turnover of assets, and we might walk away and say, hey, you know what? They're a better company. They manage their assets much better. I mean, they've got these factories, and they're earning money every and their sales are like 3 times their factory value. So they must really know how to run their company efficiently. Then I look at company B, and maybe they're only turning over twice a year. So I'm thinking this one company is doing much better. Here's the problem. Maybe the first company has old assets and that have been written down, in which case they're going to need to replace those, and they may not be efficient and they may break down. Whereas company B might have gotten relatively new assets and their turnover looks bad, but they've got stuff that is more efficient. It's going to last a lot longer, and they put the money into it. So you got to know that when you're an analyst and make adjustments for that. And within it, you got to adjust. There's something called a Q ratio, which is a little deeper than what we're following here, but it's the value of your assets over your replacement value. So a Q ratio will tell us if something, that's an important metric that we use in advanced finance, because we don't want to just know you have assets. We want to know what the age of those assets are. And so the Q ratio indicates that, because if I have one company that has $1 million of assets on the books, so factories, trucks, and they have $3 million replacement value, and then I got another company that's $2 million on the books and has the same, much less replacement value, well, obviously the other company has more current assets. Okay, so be aware of that. Okay, so those cover those two. And then, of course, you want to know what your return on common equity is. That's what your company owes. That's what you own. I'm sorry. That's what your company is worth. That's the shareholders. So what are you earning for your shareholders? And that's going to come out in earnings per share, which is your net income over every share. Very important number, because we look at earnings per share. We want to make sure earnings per share is diluted, which means it covers all the shares that are out there, options, stock, things like that. And that's a big metric. I mean, you watch any company, if you've been trading in the stock market, if you're following the stock news the way I ask you to, you'll see that earnings per share is a big number, because it's what each share is, which earnings is attributable to each share, which is the division of the ownership of the company. And then you look at your price of the stock and put it over your earnings per share, and that's your price earnings ratio, which is really important. It's one of the top metrics that we use. So, for instance, right now, the general market trades at 24 times earnings. Let's call it 25. That means for every dollar of earnings in the S&P 500, on average, investors are willing to pay $25. So think about it. If on average, if we look at the S&P 500, $1 a share, investors are willing to pay $25 a share. They're getting a 4% yield on earnings, right? 1 over 25 is 4%. What concerns me right now, and this is the kind of stuff I look at, is that the government will give you risk-free money. You can give your money to the government for 10 years, and you get about 4%. So you're getting no equity, what we call equity premium. You're getting no extra money from investing in the stocks. Only if the stock market grows would this make sense. The stock market has to grow significantly to go back to historical levels, because generally what you want to see is at least 20 or 30% more premium, depending on the risk of the market. And I'm talking about the overall market, the S&P 500. Now, the counter argument to that is, and I'm going to get a little deeper here, is that some stocks are trading pretty normally, where you can make sense out of them. And then some stocks are trading ridiculously, like NVIDIA or Amazon, some of these tech stocks, where you see that retail investors are reaching for these stocks because they feel they've gone up and they're going to keep going up, not based on fundamental value. And that's my fear. So does it mean the whole market comes in? Maybe the stocks that are more reasonable don't, and the bigger tech stocks get hurt at one point. Maybe when the biggest tech stocks get hurt, people start panicking and they sell everything. These are the things that concern me. Does it mean it's going to happen? Nah, if I had a crystal ball, I would use it. The point is, these are the things that you look at when you look at these ratios. So not only is that applicable to what we're learning, but it's also applicable to just learning how to look at the market. Then finally, you look at your debt to your total assets. We want to carry so much debt, because debt helps you leverage your profits. We don't want to carry too much, and debt is also tax deductible, but we don't want to carry too much debt where, hopefully I'm sharing. I don't know if I'm sharing here. I'm sorry about that. Let me make sure I'm sharing. Okay, give me a minute. So what I've been showing is that SCORM thing. I'm sorry about not sharing. So bear with me. So what I'm sharing right now, what I'm talking about right now is this, right? I've been going through SCORM, right? So really what I showed you was the liquidity ratios, and that's all I did. I really just showed you the liquidity ratios. Hold on. Your asset test ratio. It's all in that SCORM thing. Oh, it's just they're really just like PowerPoints. What I explained to you is what's important. If you want to, if you want to coordinate what I'm teaching you with what I showed you, it's in SCORM in Unit 3. And then I went back to this and I showed you profitability ratios, and there's your profit margin, your cash. Talked about that, your asset turnover, your return on assets, your earnings per share, and there's your price earnings ratio, which is a really important thing. One thing I didn't cover was the payout ratio, which is how much dividends get paid out of net income. Because whatever you won't pay in dividends is what you plow back. That's your plowback ratio into the company. Now, some companies are designed to pay good dividends, like Coca-Cola or IBM, because investors get into those stocks for safety. It's called a client effect. They get into those stocks for safety, and this way the clients or the shareholders expect good dividends. Some companies are growth companies, and we just want them to plow their money back into the stock because we feel they can do better. NVIDIA might be an example of that because we want them to keep growing if you're investing in them. So finally, you got debt to total assets, and debt is deductible. And then times interest earns ratio. This is important because if I'm carrying debt, I don't want to carry too much debt, just like in your personal life. But I got to carry enough to build my company or buy a house or buy a car or build a company. You want to make sure you got enough income in here after expenses so you can pay off your interest. And that's an important number that private equity will look at because they want to buy your company. They want to make sure they have enough cash that self-generates so they can pay for that, okay? They can pay for the company, the debt. And then finally, you have the net cash provided by your operating activities, not investing, operating. You're running your business over your liabilities. So you definitely want to make sure that your operating activities are paying your bills, okay? So that's basically it this week. You can go over the McGraw-Hill stuff. That's important. Where am I? You can go over the McGraw-Hill stuff. That's very important. Yeah, I'm sorry, Angelia. I wasn't. You can go now, and hopefully you saw it now. You can go over the McGraw-Hill stuff. You can go over I would go over my videos. I would look at the accounting spreadsheet, and that'll basically get you where you need to go. For those of you who for the live chat, if you listen to the whole thing and you've enjoyed it, the live chat is ratio, RATIO. Live chat code word is ratio. And that's about it for today. Thank you for attending. For those of you who didn't, you'll be watching the video. Have a good weekend. I'll see you next Friday. I'll see you next Saturday briefly, but have a blessed Thanksgiving. Thank you, Abigail. Thank you. God bless you. Have a great holiday.